Hello and welcome to the Doc Podcast. I'm your host, Dr. Mike DeLuke, and it's my mission to help you lead a happier, healthier, and more prosperous life, both personally and professionally. Hello and welcome to this episode of the Doc Podcast. If you've been following the show for a while, you know that I am passionate about helping you achieve financial freedom. There are many ways to do that, and there is no one-size-fits-all approach. And that's why I try to bring guests on the show who can offer different perspectives and different points of view. My hope is that this will allow you to gain a better understanding of what options are available to you in your unique situation, and ultimately help you achieve financial prosperity and freedom. What we do isn't easy. It takes a toll on us physically, mentally, and emotionally. I want to see you achieve financial stability that allows you to work because you want to, not because you need to. There is tremendous peace in that freedom. And that brings me to today's guest, Mr. Mark Miller. Mark is a financial powerhouse with nearly 40 years of experience helping business owners, executives, and high net worth individuals, including many dentists and physicians, legally slash taxes, grow wealth, and build lasting legacies. He is the co-founder of Hilton Tax and Wealth Advisors with Bradley J. Hilton, the grandson of the legendary patriarch hotelier Conrad Hilton. He's also best-selling author of Hilton Wealth, How to Invest Like an American Dynasty, revealing the exact wealth-building strategies used by the Hilton family and Fortune 500 firms. And we're going to discuss many of those during today's show. Mark has been featured in the New York Times, Kiplinger, and Fox News, and is passionate about educating others on how to think, invest, and build wealth like an American dynasty. Some of what we're going to talk about on today's show includes the pitfalls with traditional retail-style investing, how the rich pay little to no taxes and do it legally, why the rich invest for security and stability, even though that may seem like a surprise, and how that differs from the typical retail investor, the concepts of smart money and the family office, and how they have been used by families such as the Rockefellers and the Hiltons to create generational wealth, the drawbacks of qualified plans such as 401ks, how to diversify your portfolio like the richest families in America, and much, much more. Before we begin, I would like to add that the content and advice offered during today's episode is for informational purposes only and is not intended to serve as legal or financial advice. For advice relative to your specific situation, please consult with your own tax and legal professionals. So without further ado, let's get on to today's episode with Mr. Mark Miller. Enjoy the show, everybody. Welcome to Doc Podcast, Mark.
Well, I sure appreciate being here. Thanks for having me.
You're welcome. I'm excited to have this discussion. I try to mix in financial discussions. I tend to do a little more of it, I think, as we get to mid-late year, because I feel that is a time that this becomes in the forefront of people's minds, and they start thinking about looking at their year, how their numbers have gone that year, good, bad, and different, hopefully on the good side for people, and then starting to think about the tax planning side, not only for that calendar year, but overall and where they are in their careers. And so we're going to talk about a lot of that today in all of those different capacities and start to help people think about those things, not just short term, but long term, to create wealth and generational wealth, which I know is something you're certainly an expert in. So before we get into that and into the details, tell me and the audience a little more about yourself and how you got to this point in your life and career.
Sure. Well, I've been a business financial consultant for a number of years, too many to count, too many to admit. But in my early career in the 80s, I got into financial planning. I worked with that small little company called American Express. Mm-hmm. Did very, very well there. I was very much in on the brokerage side, buying and selling stocks and bonds, and was very much in that world. And, I've realized over a long career that that's kind of the retail world where people pay a lot more fees. They take a lot more risk, more undue risk than they need to. And I was very fortunate to meet some people and have some clients that came on board that were very wealthy, introduced me to a lot of people and kind of introduced me to what's called the smart money side of the business, or institutional. And people have probably on your podcast heard that word before, where, the fees are a lot less. There's a lot less volatility, a lot more emphasis on safety and security and protecting your wealth long term and building it more efficiently long term. And in the process, over the years, I've met the Hilton, members of the Hilton family. Brad Hilton, who was Conrad Hilton's grandson, is my main partner in Hilton Tax and Wealth Advisors. I'm also the manager of the Hilton family office. And we can talk about that, what a family office is, or maybe for some of the people that don't understand that, but have never heard the term before. But basically, Hilton Tax and Wealth Advisors are Brad and I's kind of our spinoff from the family office to bring kind of these more advanced smart money strategies a little bit more down to Main Street for folks that don't have to have, $20-30 million to plug into them. And that's been what our concept has been. We've been doing that for the last several years. It's really kind of just exploded. And our biggest thing is our biggest passion, Brad and I's passion, is just to educate people what it's like on that smart money side compared to where most people invest, and that's on the retail side. So I've had a long career, but mainly I love to work with business owners. By the way, I have a ton of physician clients, so we understand that world pretty well. And it's just been our passion to just educate people about how much better it is, kind of quote, on the other side, you might say.
Yeah. And what is it? Could you go into a little more detail? You referenced the terms being on the retail side versus the smart money side. For those who may not know, can you just give a little more color to that, if you would, in terms of what each of those are and how they differ?
Excellent. So yes, great question. The retail side is more what most people see that's out there all the time, all the advertisements on television, the Fidelities of the world, the Schwabs, the Vanguards, a lot of mutual fund companies. And, the thing that I always tell everyone that, for instance, like mutual funds are still the biggest seller on the retail side. And what I tell everyone, do you really think that Fidelity has built all those giant skyscrapers in Manhattan on getting your 1% a year? No. There's a lot of hidden fees that are inside mutual funds that people don't understand, but that's a good metaphor. And I use mutual funds as a good example because mutual funds have hidden fees that people don't know about on the retail side. So you're really paying anywhere from 3 to 4% per year in internal and external fees. And
are those itemized anywhere, or is that just kind of, they're just creeping out in places you don't see?
Say that once again, excuse me?
Are those itemized anywhere, those fees, or those are just kind of creeping out in places you don't even see?
And even, and I could go really into the weeds here, but anybody that knows about, like, in the investment acts, a lot of those acts were done like in the 30s and the 40s, when there were a lot of people that were embedded with each other in Wall Street and the government. And by the way, they still are. And there's things that they're allowed to spend money on internally that ultimately they pass on to the client.
Okay.
So that's a good example. And overall, just the fees, and that's just one example of the fees. On the retail side, there's a lot of extra fees that are paid, and that's how a lot of these Wall Street firms are getting, extremely making just tons and tons of money off of the average investor, off the backs of the average investor. So the fees are greater, but then the volatility, the other thing they're passing on to the client is a lot more volatility. In other words, a lot more risk. I'll pick on mutual funds again a little bit. I don't mean to too much, but mutual funds, the way they're sold on the front end is the largest way is those 1, 3, 5, 10-year performance figures. The vast majority of retail investors pick mutual funds just from that chart that they'll see. Well, this one looks like it's done well over those last years. So I think I'm going to go into this particular mutual funds. And that's not the greatest way to pick a mutual fund. It's not the greatest way to pick any investment. On the smart money side, which is the institutional side, the first thing that a very wealthy investor is going to focus on is not the returns. It's going to be the safety and the security of the investment.
Okay.
So the retail side doesn't want you to focus on that because they want you to come into their investments that tend to have a tremendous amount of volatility with you. You deal with the volatility, they get their fees.
Got it.
You see what I'm saying?
Yep.
So there's a real difference between that retail side of investing, which the majority of folks that we've got, even clients that have a lot of money, have, tens of millions of dollars come to us, and that's all they've done their whole life is invest on the retail side. And they wonder why this happened, that happened, this happened, is because they're not plugging into how the wealthiest of the wealthy invest.
Okay. And then with the safety and security side of the family office side, or the difference between the non-retail, what does that look like? Because when most people hear safe and secure, they're probably thinking, well, safe and secure, that's like a low yield, not going to really get me anything, not as sexy, not as exciting to be some. I know we're not talking about people who like to day trade and all that. We're kind of talking the norm, the masses, the norm of people who are just trying to earn and take some of their earnings and invest them and have an ROI on that money and generate passive income. So what is it about safety and security that actually is superior in that sense to the volatility of the retail side?
Well, you hit the nail on the head about, again, quite a bit of difference is the retail side has basically, in, lack of a better word, hypnotized people to believe that it's only about risk reward. Mm-hmm. So if you take less risk, you're going to get less reward. So you're better off. And
that's exactly what I was kind of referencing. You're right. Exactly. Yep.
Yeah. And most people gravitate, and, the markets are about, and investing is about fear and greed. Actually, you'd be surprised that a lot of the marketing is geared more towards greed, because ultimately people want the best returns they can get.
Yep.
Often at the expense of, risk in a sense. Mm-hmm. Okay. But the retail side really sells that greed a lot. That doesn't happen with very, very smart, sophisticated investors. And I'll give you a great example. Some of the most successful investors you've ever seen, like a Warren Buffett of the world, he has a very large percentage of his portfolio very safe and secure. Most people just see Berkshire Hathaway, think he's just rolling the dice on all these companies. That's just not really how it works on the smart money side. The smart money folks, again, first of all, focused on safety and security. It doesn't mean putting your money under a mattress. It doesn't mean you're just invested in government bonds. There's a myriad of other types of options and investments available on that side that people just don't know about. They don't have access to about, say, in the private equity world. There's a lot of private equity firms that offer investments that have backstops that are backed up by all kinds of different assets, things like that. So if something goes wrong with your investment, then you can get your investment back. But that investment still might have the potential to make 12, 13, 15% per year. It's about access to be able to know about those type of different investments. Mm-hmm. And you're never going to know about that on the retail side, because people are thinking, well, the only way you can have any safety and security and, quote, can't lose any money is if you invest in a government bond or CD or something like that. And then they don't want to do that because why? Because the greed kicks in. I'm not making as much greater return.
Yep.
Okay. So really what we're kind of getting into is well-balanced, well-diversified portfolios that in my and Brad's book, Hilton Wealth, we talk about the bucket system where we've got safe, secure investments. Then we've got maybe income generating investments. Then we'll have more traditional type of, say, managed money, but on a higher end and institutional grade managed money portion. And then we have our private equity and our alternative area, which a lot of people all want to know about that because, again, as human beings, as investing nature goes, I want to talk about the things that have the most return.
Yep.
But really good investors and the wealthiest of the wealthy preserve the majority of their assets. And then those other buckets we talked about, the last two buckets, those are the ones that there's smaller percentages, but it buoys the whole entire portfolio. But guess what? Now you've got a portfolio that's not going like this. You've got one that might have a little bit volatility, but far less, and then will make better returns over time. And the wealthiest of the wealthy make better returns over time with less volatility because of that.
Okay, interesting. So it's diversification in a sense. A lot of times people hear diversification and they think diversification within 2 or 3 buckets of retail type investments, right? Like you said, like the bond market area, then maybe a little bit more of a mix toward the stock arena, and then maybe one that's more aggressive. You're saying that those, say, let's just call them 3 buckets, are really just 1 bucket of your 4 buckets. Am I saying that correctly?
Yes. And the one thing that it's very important for people to understand is that on the retail side, again, you were taking the majority of all the risk. And we see it with new clients that come on board now because we've had a run up in the markets. We have our own theories on that, why that is and everything. But that, hey, so as the markets run, a retail investor tends to more gravitate towards those investments. And then what happens, obviously, in the inevitable time when the markets rebound and they go not our way, people lose giant chunks of their portfolio, freak out, they sell out, they don't know what to do, they're lost. And rightfully so, because they have too much of their assets exposed that can lead to huge drawdowns in their portfolio. Okay. So that again goes back to kind of that retail investing philosophy. And that is what we teach people. We educate that we don't believe that's the best way to invest. We think that the majority of investors, if you have 500,000, a million, 2 million, 5, 10 million, that you need to be investing in a much smarter, more efficient way, like the wealthiest of the wealthy invest.
Interesting. With the numbers in my audience, I have docs of all ages and laypersons too that listen, that we're going to hear some of this and think, well, that's just for the big leagues. That's another level. You're with the Hiltons, and
it used to be that way. And that's what we're trying to remedy. And it's happening more and more with the information revolution and all that. People are getting more educated, but you still have to know where to go. The problem people have, you can read a book all day. Oh, I need to invest this way. Where do I go to invest that way?
Right. That's what I was going to ask.
And how do I get a holistic portfolio of being able to invest that way? And that's really what Brad Hilton and I have done with the Hilton Tax and Wealth Advisor. And that's kind of our passion, is to try to educate people that there's a better, more efficient, and less volatile way. Now, let me give one more kind of example here. Is everyone hears about this model, and it's a retail model that was developed years ago, not necessarily as the greatest way to invest, but more as a great way to market and bring money in on the retail side and sell money, in a sense, sell their investment services, is the 60-40 model. That you may have heard of this, and many people have. If you put a certain percentage in equities and a certain percentage in bonds, then you're good, because they kind of buoy each other at different times. Well, that's been blown out of the water really since the mid-90s, and especially when .com bubble hit, 2008 hit, because both stocks and bonds collapsed at the same time. So much for that model. Well, guess how they're still selling retail managed money?
60-40.
60% of your money in equities, 40% in bonds. It's ridiculous, because what's going to happen, and if people are listening right now, and that's how their portfolios are set up with a retail advisor or a broker or one of these, big firms, well, they're going to get slammed at the next market downturn and market adjustment, because the longer that the markets run, the more that they're going to eventually correct. The old adage, what goes up must come down. We know that's going to happen. We think that it's been prolonged for certain reasons, and it may be prolonged a little bit longer. But when it does hit, if your portfolio is set up like that, you could easily see a 40, 50, 60% drawdown in your portfolio. The problem with drawdowns is, and again, the wealthy know this, but a lot of retail investors don't, is that when you get that drawdown, you sit around for years waiting to get back to even.
Right.
When you could have taken less risk in your portfolio and then for 2 or 3 or 4 years while you're sitting around, make decent, solid rates of return in those years. You see what I'm saying?
Yeah.
So again, that's another retail concept that people are still buying into, and the retail markets haven't changed. Why? It still sells money. Still sells money under management because people just don't know any better. They don't know that's a completely broken model, but they are still using it to this day, the biggest firms, to sell managed money and money to go into their portfolios.
Let's say you take somebody who comes out and they've got $100,000 of dispensable income and they're looking for something to do. And their financial advisor or their broker is saying, oh gosh, let's take that and invest it into paper assets. What would be the other options with your model for a person in that position?
Well, first of all, what we've done is bring these kind of advanced models, the barriers to entry way down.
Okay.
At 250,000, we can build one of these portfolios at about 250,000.
And is that of 250,000?
100,000 is a little low.
Okay, so 250,000 of initial investment, not of net worth or of liquid assets. It's
absolutely, yeah. We're talking about investable assets.
Okay.
That we can build a Hilton True Wealth portfolio, which is what we call our portfolios, with 250,000 minimum.
Got it.
But most of our clients might have 500,000 million in that range. But we can do that. If you start talking 100,000, well, then that starts getting down in some of the minimums that we have in some of the entry to the different investment options that we have, the myriad of options that we have. But we can still maybe possibly invest something if people come in on the tax side, on tax planning to lower their taxes, and then we can save them a bunch on their taxes and, help them redeploy that into more efficient portfolios. Okay. But that's been the whole point of what we've done, and the passion that Brad and I have is to, let's lower the entrance barrier big time. And that's been a really neat thing to experience over the last several years, because how do we work with our issuers to bring it down, get them to understand what we're doing, how we're doing it, why we're doing it, and to be able to bring it down. And we've been able to bring it down, clear down to the $250,000 level.
Yeah, it seems like that's an interesting model that's happening across many industries. I have a family history and a personal history in the thoroughbred horse racing industry. And it used to be, you had to be heavily invested as a single owner. And then it became fractional ownership, where you would have separate LLCs own one horse. And now it's fractional of fractional, where they're literally letting people get in on some horse ownership. I mean, for like a few $100s or $500, you can own a piece of a horse. So that model of bringing what was this very elite exclusionary concept, not in a nefarious way, or it just was the nature of the business, has totally been reformed to bring it to the masses. And with that, it drives up everybody's share, but it also becomes, to what you were saying, more safe and secure. Because if you buy your own horse at $250,000 and that horse has, forget it. Yeah. Whereas if you put up, $1,000 and the horse doesn't do well, yes, the upside's not as great, but also the downside's not as great. And then you can invest in other areas as well. So it is an interesting, as you're speaking, I'm like, oh my gosh, this is like fractional horse ownership in a sense of the game is the same. You're just allowing it to be accessible to different people.
Absolutely. And along those lines too, we're doing a lot of work in the digital asset space and digital currencies. And as a matter of fact, we're about to launch the Hilton Technology Fund. That's going to be heavily in digital assets, will be AI, robotics, biosciences, and things like the real cutting edge stuff. But it's funny because we were just at a meeting of a bunch of wealthy people up in New York, and there were people that were actually talking about tokenizing in the horse racing industry.
Yes.
So actually
I know a lot. For full disclosure, I'm involved in that.
There you go. And it's just really cool stuff. And it's bringing the 21st century into investing now, where we're still stuck back in, and that's even the retail model is still stuck back in, the 19th century. And these are the type of things, you're absolutely right. Now the barriers to entry are going to be a lot less. This is kind of why what Brad and I are doing in this whole area and why we've been passionate about this, because I think it has a lot to do with the information revolution, that people are starting to get more and more and more educated, but also people on the institutional side or the smart money side are getting more educated, the issuers themselves, and understanding, wow, there's a big market here. We didn't think there was any market there before. Go let the retail people do what they want to do. Okay. Now they're realizing just one by one that there is a lot of money they're leaving on the table that they can bring, more the average investor in various very, very, interesting and creative ways, just like we're discussing about.
Yeah. And because so many docs, and you deal with a lot of them, we're not trained in business. We don't understand this. It's beyond our pay grade, literally. And we dabble. We might get involved in ownership of a friend's business or make a real estate investment, and maybe it doesn't go well. It kind of just says, well, let's just kind of play this the typical way, which is where you put most of your money into pre-tax investments through retirement portfolios associated with your practice. And you just are supposed to watch that grow. And then eventually that'll be your nest egg you have when you're there. So if someone doesn't have, let's say they have a fairly significant net worth, but they don't have $250,000 of investable assets at that point.
Yeah.
And I know this is, I said in the intro, this isn't specific financial advice. For certain people, have you seen clients where they will sell off a portion of their pre-tax if that's all they've got and they want to get out of it? I'm just trying to think of ways for people to get into this other game, into this smart money game if they're in the traditional pathway. Sure. Sell it off, take the hit, pay the taxes, pay the fees. And how would someone get in if they're not?
Well, not necessarily. Now, that's a whole nother conversation about tax efficiency, because one of the things that, and people are getting more educated about this, but it's great that you can get a little bit of a tax advantage, put money in a 401k, an IRA, a KEO, whatever they might be in, and get those tax advantages and allow the money to grow tax deferred. But the thing they're ignoring is they're basically giving themselves a massive kind of tax, and there's been people in the industry that call it a tax time bomb. Yeah. When it comes time to start taking money out. And and how do we know this? Because we have personal experience with clients that come on board, and the last thing they want to do, they have giant qualified fund balances and they don't want to take a dime out of it. There were so many people that were so happy. Oh, great. Now I don't have to take out until I'm 73. Before it was 70, now it's 73. Oh, that's great. They're doing everything, bending over backwards to not take money out, because when the second they take money out, they just bump themselves up 2 or 3 tax brackets and are paying massive taxes. So that's one of the things we work with our clients on it in tax planning, is try to get those out of there in tax advantage ways, so where they don't have to pay massive taxes. Okay. And then convert those either Roth IRA conversions or various other kind of proprietary plans that we have to ultimately focus on having, whenever we take, whether it's retirement, you're focused on, or whatever it is, or when you're taking money from those funds, we want to be as tax-free as possible, as much as we possibly can. It's one of the concepts that the Hiltons have used for years. When you take money, you make that money completely tax-free. However you need to design your portfolio, your assets, your estate, you're pulling it out, and you want to pull it out tax-free. That way, you're not all of a sudden hit with 30, 40%. Basically, that is a loss in a sense that you're incurring because you have to pay a massive amount of taxes.
Yeah, and legally, obviously, people hear that and say, well, you can't do that legally. No, you can. I just want to clarify that you're not saying doing anything of tax evasion. It's tax avoidance. Of course. It's legal. The government, I tell people all the time, the people who, this is an old Rich Dad Poor Dad Robert Kiyosaki concept, the people who make the rules keep the gold. So the politicians that for many, many years in this country have written the tax law to evolve into what it is today, did it so they could get rich off of that. And anybody who thinks otherwise,
so the government can get richer too.
And great point. And so the government can get richer too. It's all part of the bigger plan. And we just become kind of that hamster on that wheel, and we're busy in our practices, we're busy in our day-to-day lives. It's threatening and confusing to think about doing something different. It feels good, it feels comfortable to just give your money to the traditional means of investing it and seeing, and if you watch it over a month of quarter, or even just say quarterly, you're usually, especially recently, seeing growth in that portfolio. The thing you hit on, which I want you to dive a little more into for some of those who may not think of it this way, when you get to save tax-free into a 401k plan, it is only, and it grows tax-free, it is only tax-free right now.
Yes.
It is not tax-free when you take it out of that vehicle. I know Roths are different, but when you invest, they're going to get their cut of that income that you earned to invest those dollars at some point. And the thing I think people don't understand, and then I want to hear your thoughts on this, and some of the strategies you use would be great. People don't realize that is coming out all as income tax, not as capital gains. And we think about it differently, but everything you withdraw on that type of vehicle, you are paying income tax on. So you might see in your portfolio, oh my gosh, I've got $3 million in this 401k account. No, you don't. You have two if you're lucky, right? I mean, would you agree with that?
Absolutely. Absolutely. And, here's a great story in the 70s and 80s, when these concepts were coming up about, allowing Americans to get into qualified funds, there was a Senator Roth, which everybody knows that name, was fighting. He and his group were fighting against the senators and the congressmen that wanted just regular qualified funds. Just to give them a little bit of tax benefits on the front end. Ultimately, the whole point of this was in what really made all these politicians lean over to the side of, let's just give them regular, a qualified option, an IRA, 401k that came a little bit later, but the same concept. Because basically what they saw that as, the ones that were very connected and really understood the system as, we can take, instead of taking this and putting it in a pension fund or something, or Social Security, we can take it, let people take the money, put it out into the markets. We know they're going to make a whole lot more money. And guess what? Down the road, we're going to make a lot more revenue.
Yep.
Okay. Ray Dalio, one of the greatest investors ever, said, it's the difference to the farmer. It's the difference between paying the tax on the seed or paying the tax on the crop.
I hadn't heard that. That's
massive difference. Well, Roth IRAs are paying taxes on the seed. But then that crop yields so much more from the seed that on the back end, you're so far ahead. And he ultimately lost the argument because there were too many that were saying, and working with the IRS and saying, no. If we allow all of Americans to put trillions of dollars in these, we're going to get trillions more in taxes and revenue down the road.
Yeah, okay. Trillions plus compounding interest.
Yes, absolutely. Plus compounding interest, so much more. And then the Roth was kind of an afterthought. They didn't reject it. It was just kind of an afterthought.
Hence the minimums, I'm sure, right? The restrictions and the minimums, right? That's probably what was tied to it. I can't even
imagine what it would be like for Americans now, and even for my clients, if the Roth would have been the foremost qualified plan that the country was focusing on. It would be, people would be sitting on multi-millions of dollars in non-tax income for their retirement, which would have been truly the best for them. But instead, people are sitting on hundreds of thousands, if not millions of dollars of qualified funds that, guess what, they run away from and they don't even want to touch. So their lifestyle goes down. Okay. So it's just the opposite of ultimately what it was supposed to be designed to do. Allow Americans to put some more money away so they can have money, their own money at retirement.
And on inheritance, there are, correct me if I'm wrong, there are much stricter rules on the qualified funds in terms of how they have to be spent down by next of kin, correct?
Absolutely. You don't get away with that money being just because you pass away. there's no step up in basis on those.
Right.
To where they're like there is with a lot of assets, to where there's no tax set when you pass away for your heirs.
Right.
So that's a whole nother thing. So anyway, we could go on and on about education on that, but the bottom line is, I think people have to be very wary of the government coming out with things, and on the surface it looks like it's great and it's wonderful on the front. But when I was young and getting into the business, I even knew that was a mistake. But it was like a steamroller.
How'd you know?
It was just like, and then 401
was it just instinct
came along too.
Was it just instinctive that you knew, or was it just, how did you have an awareness of that before others?
I think it's because how, and I wrote some, books in the 90s and everything. I was just very plugged in. I read a lot. When I was young, I had just this, incredible appetite for everything I get my hands on and read. And I knew right away. I spent a little time in Washington, and when I was young, working for Bob Dole, Senator Dole, and I just knew. I just said, obviously the route to go is the Roth route. And I think there were many politicians that knew that too, but they were getting a lot of pressure from the IRS, various other lobbyists and everything to say, no, this is great. The American public's going to love it. And it's going to allow for us to grow the government over time massively, which it is, because people can't get around. If you've got qualified funds, now we do a lot of planning to get people out of that rut. But if you've got qualified plans, you just need to understand that a huge percentage of that is going to go to the funding of the government. So anyway, so that's another thing that we focus on with our clients. And we just, you can't have that for your estate and for your portfolio long term. Otherwise, it's going to kill your wealth growth.
So what do you say to the people who hear that and say, yeah, but Mark, I don't want to pay more taxes than I pay right now? Because otherwise, if they're not putting those into a pre-tax vehicle, qualified fund in that sense, 401k, the profit sharing plan, they're going to have a higher tax burden today. And we are so averse, right there with everybody, not passing judgment. Yeah. No one wants a higher tax bill, especially in their peak earning years. It just doesn't feel as good. And as you said before, investing is so emotional, and the government knew that, which is why obviously, right, they set this up this way. It feels really good to be like, hey, or meet with your accountant in your fall planning meeting you're doing and looking at your numbers for that year. They're like, hey, doc, you can set aside an additional $100,000 here and decrease your tax burden. It feels good. So how do we stop that delayed gratification and realize?
That's a great point. And I blame CPAs too. And that the problem is, it's not that they're bad or they don't know what they're doing. It's just that they have no financial education. People think they're CPAs are money gurus because they can do the taxes that you don't want to do and can't do or whatever. The reality is that's their go-to. There's two go-tos for CPAs. Number one is make sure your entity planning is good and all of that. And number two is, oh gosh, you want to save money? I've got this great tax planning tool for you. Yep. Put your money in an IRA, KEO, 401k, put a 401k into your practice, do a SEP, whatever it is, whatever works for your situation. And that is your tax saving tool. And that's it.
Yes.
And then it stops.
Yeah.
The reality is that on the front end, there's things that we can start doing. We have some proprietary programs, like we kind of have a 401k on steroids, way to put your money away and get tax advantages on the front end, plus be tax-free on the back end. But we do a lot of Roth IRA conversion, but then we'll couple it with tax planning. The biggest aversion, the reason why people don't do Roths is, let's say you have $1 million sitting in a Roth IRA, you just converted it all at once, you could have $300,000 or $400,000 in taxes due.
Sorry, just to clarify, $3 million sitting in a non-Roth.
Yes, in a qualified. Did I say Roth? I apologize.
Yeah, sorry.
I apologize.
No worries. No, I just didn't want
to. Qualified, say IRA, 401k, something like that. That when you then convert it to a Roth conversion, people don't want to do that because of the taxes.
Right.
Well, so then we'll tack on some formalized tax planning to where we can get that burden down to very little, if no taxes at all, when you make that conversion. So we want to convert as much as we can. We usually can't do it all, but a good portion of those qualified funds over to Roth. So then when you're ready to pull it out, then it's completely tax-free. Okay.
Interesting, yeah.
So that's what we work with our clients on the tax side. So the tax vein kind of runs through everything that we do, both from the investment standpoint, but then also, and I mean individual investment standpoint, but then also as an overall plan, we're working people towards when they're ready to withdraw that the vast majority of everything that they're pulling from is completely tax-free. So another way to the wealthy just get wealthier. It's just much more efficient and just accelerates their wealth growth.
Yeah. I love the tax side. I probably geek out on that more than the audience wants to hear because it's just something it's just such a part of the game. You know, I mean, you really can't. John Bento, who's my CPA, who also has financial advisory services and part of his firm, he says the biggest, when he lectures and speaks, he says, what's the single biggest expense that you'll ever pay? And people don't think of it that way, but it is taxes, and it's not even close. By far. Like, it's not even close. So to me, it's just such an important part of wealth generation. And again, all legal, all tax avoidance. We're not talking about breaking any rules here. It's just there are legal ways to do this, and that's what the wealthy. That's the other side of the board. That's the other side of the game board, is when you flip that board, there's a whole nother game over there, which is what you're talking about. What role, if any, in this does whole life insurance play? I've spoken to people before who talk about that, using that as like your own bank, so to speak. And what are your thoughts on that? What role do you see that playing?
On our end, and nothing against some of these infinite banking strategies, all of that. Whole life, though, on our side, is not really used that much. The wealthy don't use whole life because in some circumstances they do, maybe for some estate planning, things like that for their heirs, some more underlying guarantees. But we tend to use kind of institutionally based universal life only because there's strategies that people can invest in now, institutional based strategies inside the policies that double, sometimes even triple the rates of return that you can get on cash values in whole life. Don't get me wrong. I think there's a place for it, and there's a lot of people that on the retail side, they use those, but our feeling is there's just better options. If you're going to use somewhat of a similar type of strategy than that, why not, double and triple your ability to make money in your cash value with some more advanced institutionally designed type of policies? So
there are other ways to get that sort of personal banking benefit without having to go that route.
Absolutely. And again, that's a concept that's been very, very sold, and a lot of people know about it, and a lot of people come to us and they might have these whole life policies. And again, I mean, it's a good concept. It's a great concept, but we want to put that kind of on steroids for our clients. So it gives them a lot larger, nest egg in their cash value, and ultimately even more death benefit as their backstop over time. Okay.
Yes, I know a lot of those are very heavily loaded on the front end too, though, to get into
there's a lot more fees in whole life policy than there tends to be in universal policies. Not to say that there's not fees in both of them, but on the universal side, again, it gives us a lot more flexibility on the institutional side just to grow our wealth to a greater extent over time.
Okay. And as I'm speaking with you, it's kind of hitting me here. You're very well versed in all of these arenas. Is that part of this family office? Is that what it means? Is that you've got people who are experts in all of these arenas, the tax arena, the investment arena, the life insurance arena? Is that what that means?
Right. So the family office concept was, and we just actually spent time, we were on the platform with the Rockefellers up in New York. The Rockefellers started the family office concept, and basically what it was John D. Rockefeller was having problem. All of his advisors were fighting with each other and fighting against each other, and it was causing tons of headaches inside the family. It was stifling the growth of their wealth over time. He came up with the concept. Here's the deal. Let's fire all of these folks, except the ones we really like, but then let's hire them directly into our, quote, family office. Let's hire them to all work. And then they all of these different advisors, the insurance folks, the financial advisors, the estate planners, the risk mitigation folks, all of these, let's hire them into one office. Then they can all talk to each other, and then they're all working towards our benefit. Well, within 5 years, they doubled their wealth. And he spoke for many years about it was because of that. So that's an individual family office. Then over the years, it developed into kind of a multi-family office where a lot of wealthy folks can get into. And also they also kick off, they all kick around ideas with each other too, from the different families that find out about different things, which was another layer of efficiency. And so it moved to multifamily, and now these days it's moved into more virtual family office, which is what we are, which is going out rather than hiring all of these people in a certain area. Now, if you live in New York, that's one thing because you can find some really good people, some of the best people in the world there. But if you don't live in New York, you're not in New York like we are, our family office is located in Atlanta, then what are the odds that we're going to find the best people in the world to work in all those different areas in Atlanta, Georgia? Not good. So we basically go, we kind of outsource, not just around the country, but all around the world to bring the best people in. They're still all communicating and talking with each other, but they're more of on a virtual basis. That's why they call it the virtual family office.
Okay.
So that's what it does. It allows just to get better efficiencies, better communication, better collaboration. And a lot of the wealthy families are really moving towards that. The other thing it allows for is to bring not as wealthy families into the family offices. Maybe you don't have to have, 30 or 40 or $50 million. You can have a lot less. The barrier to entry is a lot less to be able to be part of the family office.
Okay. What does it involve from the end user standpoint? If they are involved with your team or the family office concept, is it set it and forget it? Are there meetings quarterly? How do you tailor it to each individual?
Well, Hilton Tax and Wealth Advisors, I will tell you, generally, most of all our folks that are in the family office have 20 million plus.
And net worth at that.
Yes.
Okay.
Total net worth.
Yep.
20 million plus for the family office specifically. But again, Hilton Tax and Wealth Advisors, we're bringing a lot of those family office concepts, majority of them, and it's getting that way more and more every day, more down to folks that maybe have $500,000 or $1 million, in that area. So, and then they can get that same kind of level of service to where you mentioned quarterly meetings. We have quarterly meetings where everybody's getting together. We're talking about taxes. We're talking about investments. We're talking about their estate planning, various other areas that are all more holistic with Hilton Tax and Wealth Advisors also. So again, that was our whole concept. And I realize we've only had a certain amount of time to talk here, but in my book, Hilton Wealth, Brad and I talk about what is the difference? What is the real difference? And I would invite everybody to go to our website, which is hiltonwealth.com. You can order a complimentary book on hiltonwealth.com. We'll send that out to you. And then you can really kind of get a much better feel of what is the real distinction and why we believe, for things we've talked about today and a lot more reasons why it's much better to invest over with the smart money than it is the retail money.
Okay. And then what role, again, I realize you can't speak and get too granular on it, but generally speaking, real estate is what part of the overall plan is that because a lot of people have interest in that as well. Is that incorporated into one of those 4 buckets you were talking about? Is it kind of
absolutely
distributed?
So that real estate is in our private equity alternative bucket.
Okay.
I think that's great. I think it's excellent. We have a lot of clients that have accumulated a lot of real estate over the years. We help that kind of fill out those buckets. One of the things one of the problems we run into, we're working with a client right now that has very lopsided. They have 80% of all of their assets in real estate. Now they know real estate and they've done well in real estate, but they've also realized I don't have a very well-balanced portfolio. Sooner or later, real estate is going to take, its dreaded turn that it always does. What is that going to mean to my portfolio? And they start understanding and learning that there has to be some balance. So we're working with that individual right now to liquidate some of his real estate that he's not as happy with, and then get it more in types of investments that are more passive. What's his goal? He wants to make 9 or 10% per year in his real estate portfolio. Well, we can do that with a passive portfolio, and you don't even have to worry about the management. In his case, the managers he was working with that were doing a terrible job on 2 or 3 of his properties. So he's like, I want to liquidate these, get out from under that management, that manager I'm working with that happened to be a family member. So that's another issue. But it's all about balance. It's all about, being well allocated, well diversified, and having a good balance that's going to get us the best returns long term and not going to create massive heartburn, on those years when those higher risk assets inevitably make their turn. And then we're sitting there going, oh my gosh, what do we do now? Didn't expect this. I made a lot of money, but I sure didn't expect this kind of drawdown, that type of thing.
Yeah, and you actually just anticipated my next question. And what I wanted to ask you about is, I know because I know a lot of people in my audience, and I know the general situation that a lot of orthodontic, dental, medical colleagues get into. And that is they end up with really large sums in these qualified assets, maybe some in just, post-tax investments and stocks and bonds. And they're maybe getting a pit in their stomach right now, hearing some of this, thinking, yeah, that's me. I'm 20 years into my career. I have put essentially everything into these vehicles. What advice do you give to people like that who are maybe feeling a little uneasy with hearing what you're saying?
Well, again, we talked about it earlier about the tax time bomb. Basically, what you're setting up is a tremendous tax burden for the latter years of your life when you're ready to take income, and especially your estate. So what we do always, and you're spot on, this is what we see. I mean, I totally concur with you. We see it all the time, big chunks of money because there's a lot of cash flow that comes through doctors' offices, whether even if they're W-2'd or whatever, there's a lot of cash flow there. And again, the only option they have generally is what they have exposure to, they think, is their CPA tells them put more money in your qualified plans. So they do that, and it causes this tax time bomb. So they really have to get a plan to get those monies, as much of that money as possible, in as a tax efficient way as possible out of those, to then make as much of that money as tax free as it possibly can be.
Okay, and there are ways to do that. It goes beyond the scope of today to get into that, but there are options for them.
There are, and there's several options, but those tend to be more on the smart money side, institutional side, as opposed to the retail side of the business, that maybe people get exposed to them, but then they see all the taxes to do that they're going to have to pay, and they just like, oh, forget it, and just keep doing what they're doing and creating a bigger tax time bomb. When that's actually when they start drawing money from those.
And kind of on that note, if you could give 3 tips, just 3 things to the average professional out there who doesn't know about the smart money concept, is not involved in that, has good margins, is doing well, or is earlier in their career and they're starting to get their expenses under control. They've got some margins. It's something I talk about a lot on this show, the importance of being disciplined in your fiscal approach to your practice and your personal life early on, disciplined spending, budgeting, and then you've got margins. So we're talking about some people who have some margins. They don't know anything else other than what we've already talked about through this episode. Doesn't have to be 3, but a few concepts that could just help that person understand what to do.
Well, I would first say you need to focus more on safety and security than you probably are. Okay? Because the wealthiest of the wealthiest do that. You need to also make sure that your fees are down as low as they possibly can be, because the fees over time can add up to hundreds, if of thousands of dollars less than you have. Okay. So fees are a big part of it. And then I would say the third is volatility. Figure out a way to get less volatility, because less volatility has been proven. There's been Harvard studies, MIT studies. The less volatility you have, the more you will make and the better you'll do in investing long term. And again, that's a little counterintuitive, because people think that, well, I need to just deal with that. Or their broker just tells them, hey, just know that you're going to have a year when it goes down. Don't worry about it. Don't sell. Just keep it, blah, 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 all of that. But when there's been the best of best studies that have been done that said, no, you need less volatility, not more volatility, to make more money and have and build your wealth. And then the final thing I will say, and we've touched on all of these things, is that you've got to have a plan for the biggest expense of your life, which we say too, and that is taxes. You've got to get your tax burden down. If you do that one thing alone, you could put, an extra 20 or 30 or 40% per year back into your pocket that goes back into your building your wealth. And that is the last thing I would say, that is probably the number one and the biggest thing that builds wealth for the wealthiest of folks. That's why you hear all the time the wealthy don't pay taxes. Yeah, they're not doing anything illegal. And, whatever your politics are, whether you like Donald Trump or not, I don't think Donald Trump has done anything massively illegal. He's just taken advantage of all there is to take advantage in the tax codes that, by the way, were all built by wealthy people.
He said as much, right? In the first time he ran. I mean, he literally said just that. And
he did. But of course, everybody, on the other side was, oh, no, he's evading his taxes and all of that. That's not the case. The wealthy of the wealthy, you'll see that all of those people on the Forbes 100 wealthiest list, all of those lists that they're on, virtually every single one of those folks don't pay taxes. Now, we can go into a debate on that. I think that's okay, because ultimately those people drive our economy and allow there even to be taxes. So I think it's okay. They're providing so many jobs and producing so much, revenue into the system, but it has to be done legally, morally, ethically, obviously. But that's such a huge way that the wealthy get wealthy and build their legacies and build long-term legacies for their family too.
I love it. I'm going to let you have the last word with that, because I think that's ultimately what it comes down to. You do things morally, ethically, legally, and the goal is to try to build a legacy that you can pass on and not riddle your next of kin with a significant tax burden or liability on the other side of things, or just management headache of trying to deal with the assets you pass on.
Yes.
Right? I mean, that's another challenge. You got to, right? I mean, that's a big part of it. You don't want to just throw this to the next generation and have them try to clean up all the things you've built. And so there's a challenge in that.
Yes, absolutely.
So I really appreciate this, Mark. You mentioned your book, and I'll put a link in the website. How else can people reach you if they have more questions or want to learn more about what you do?
Just go to HiltonWealth.com is the easiest thing. You can contact us there. They're welcome to, if you'd even like to have a chat with me personally, maybe about a 20-minute chat or so about your finances and your situations, and we can talk about if there's any different options that you might have, or we could do an assessment for you, and if it comes out you're doing everything great, we'll tell you that. If there's some improvement we think that maybe you could install or have, we will tell you that too. It's very similar to the second opinion, right? And I know a lot of doctors don't like to hear that word, because they're like, oh, you want to go get a second opinion. But you know what? Especially in the financial world, I think it's important to get a second opinion on what you're doing, how you're doing it, and see if anybody can add any color to it.
Yeah, I completely agree. And in practice, never minded when someone was getting multiple opinions. I just looked at it, that I had to be that good and that honest and that dedicated that when people had to judge, they would choose my services. And I agree, we all get that. It is something we all get a little bit prickly about. We're like,
absolutely, sure.
But at the same time, it's like, well, then, if you're not hiding anything, then you should be more than open to other people exploring those options.
Absolutely.
Yeah. Well, thank you so much for your time. This has been great. That was a quick hour. That went quickly. I hope the audience enjoyed it as much as I enjoyed it, and like to learn about this and really just try to advance the education of people who aren't exposed to this content. So thank you for taking the time to come on to expose an audience that probably hasn't heard a lot of what you were saying to that information.
Excellent. Well, very much enjoyed it, and thanks for having me on.
Great. Thanks, Mark. Thank you for tuning into this episode of the Doc Podcast. Be sure to visit theorthocoach.com to get access to ADA CERP recognized CE courses or to schedule a private one-on-one coaching session with me. Also, if you know of someone who would make a great guest for this show, or if you'd like to be a guest yourself, please email me at drmike@theorthocoach.com. And be sure to join the Doc community on Facebook for more great content. Thanks so much for listening, and always remember, you have been blessed with the ability to do amazing things.